This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. You're listening to episode 196. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the MicroCap message. Quick announcement. As I said in the last few pods here, we are about 2 months away from the SNN Network Canada virtual event. That's happening December 7th through 9, 2021. Paul Andriola from Small Cap Discoveries and myself on behalf of SNN Network are teaming up again to highlight our neighbors to the north, Canada. In the last 5 to 10 years, small, micro, and nano cap investors have been finding value accretive opportunities on the TSX, TSX Venture, CSC, and now the NEO. And so we wanted to host an event that encapsulates all of those opportunities in one place. So you can expect 3 days of keynotes, educational panels, company presentations, and one-on-one meetings. To register, please go to canada.snn.network and click the register button. We look forward to seeing you all there. Now, for this episode of the Planet MicroCap podcast, I spoke with Harris Perlman. He is a full-time microcap investor, microcap club contributor, and better known as @OtterMarket on Twitter. We've crossed paths at many events over the years, and I'm really stoked to finally get Harris on the show to discuss his passion for microcaps. As you will hear, Harris was a big gamer when he was younger, and while considering investing in the stock market, he notes that with investing, you want to play the easiest games possible, which ultimately led him towards his journey into investing in microcap stocks. Listen in to hear his investing framework, how the microcap universe has changed, various ideas, and much more. So thank you again for tuning in to episode 196 of the Planet MicroCap podcast. And please enjoy my conversation with Harris Perlman. Everybody to the Planet MicroCap podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft, BOBBYKKRAFT. And I'm very excited to have our next guest on here today. We've definitely crossed paths at every microcap event that's been out there, a fellow millennial in the microcap trenches. And I'm talking about Harris Perlman, better known as @OtterMarket on Twitter for all you FinTwitters out there. He's a full-time private investor as well as active member of MicroCap Club. With that, Harris, it's a long time coming, man. I'm so stoked to have you on.
Yeah, man. Happy to be here.
So, should we give the people what they want from the get-go and going and digging right into the microcap? Or should we okay. We'll start with where your passion for investing began, and then we'll give the people what they want. So, where did your passion for investing in microcaps begin?
My passion for investing, I guess I would explain the passion side of it as just loving games. Ever since I was a kid, I really loved games, and a lot of microcap investors probably have nerdy backgrounds. In high school, I was this kid who actually played competitive games. I would go to like board game conferences. Literally, they exist. I even played some of these really nerdy tabletop miniatures games. And I love that stuff. I was really into that stuff. I loved entrepreneurial ventures. I mean, I didn't have a lot of businesses, but I was shoveling or snowblowing people's driveways in the wintertime. I grew up in New Jersey. I had an eBay business. I was buying and reselling stuff that I found at garage sales on eBay. That was a lot of fun. And Yeah, so once I ended up learning about the existence of the stock market, and I started learning about the fact that it's about businesses, and it's this game you can play basically to make money, it just naturally drew me to it. And I've tried to just refine my technique over the last 10, 15 years.
Very cool. So going back to your professional gaming background, I have to
Oh
like,
boy,
I have to ask about that because
okay.
see, me and my friends think we're like nut jobs about like playing board games and stuff like that. And that, like, you know, I remember the first time, you know, it was the first time my wife played Monopoly with us, and she's like, "This is how you play Monopoly? Are you nuts? Like that? This is not." But so, like, what games were it? Was Monopoly, Risk, like, or just
Oh
everything?
man. So okay, so when I was in middle school, me and my friends would go on Friday afternoons after school to the local comic book shop, and we played Settlers of Catan, which is where we learned how to play it. We were like 12 years old. I mean, this was like 18 years ago, man. And it was not mainstream then. You know, you wouldn't have that in a Barnes and Noble, right? To buy a copy of Settlers. I played Magic the Gathering. That was big in middle school. In high school, I was also really into this miniatures game that was so much fun. I think it's kind of fallen out of popularity, so I doubt if
What
there are
is
people
it?
playing it.
It's called miniatures.
Okay, no. So there are different kinds of games with these little figurines that you play on a board, big like tabletop. And the one I was really into was called Hero Clicks, and this was literally superhero figures that each had their own stats, and you had to assemble a team of them, and you basically just did battles against the other person who had their own team. You collected this stuff. It was addictive. I think I probably spent most of my allowance money and a lot of my other business venture money as a kid on these games. And I mean, I have to give a shout out to my mom for driving me around to go to these tournaments and play this stuff just for fun. I wouldn't have been able to experience the passion of playing games as much without some transportation at the time.
I'm sure she had no problem. She's like, "Oh, you want it? One, you're passionate. Two, you want to go to this turn. You don't want me to take to these crazy parties, right?" It's like, well, no problem.
She at that point, she was sort of interested in getting me to the parties a little bit, but yeah, I had very supportive parents who still have very supportive parents who are willing to let me, without judgment, pursue sort of unconventional interests, including when becoming a full-time investor. I think a lot of people would have a lot of pushback from their families when they decide to make that jump. And I am very lucky that my parents were very understanding of how I wanted to approach it. And so it was an easy thing.
So then how did you discovered investing, you discovered there's these games that I can play and make money via the stock market. You know, what then led you to microcaps?
Well, I've said before that I think the best games to play are games you can win. And when it comes to investing, you want to play the easiest game as possible because all money's green, whether it comes from, or American money, whether it comes from a large cap or a micro cap or a piece of real estate or what have you. So I think history and studies have shown that microcaps are the most inefficient market of the public stock market. So if you have a small capital base and you can reasonably expect to deploy it in those small companies, I think you'd be doing yourself a disservice to not focus on microcaps.
Very cool. So then catch us up, again, before my last question on background, and then we'll dip into the microcap crazy fun stuff.
Yeah.
So then how'd you get your start? And then when were you able to make that jump to full-time investor? Because hey, by 30 years old, being a full-time investor in microcaps, like that's no easy feat.
Yeah. So I used to work at a hedge fund. I was there for about a little over 4 years. And before that, I worked for 1 year at BlackRock after college. I was interested in investing when I was in college. I was investing my own account at the time. I co-founded and co-ran the investing club at my college. And the whole time I was really just interested in learning as much as I could. So obviously I read a lot of books. Everyone at this point has probably gone through the basics like intelligent investor, security analysis. You can be a stock market genius, all that stuff. They're great books. And I got some hands-on experience working at a fund. It wasn't a lot of microcaps because it was a larger fund, but I got a lot of hands-on experience that I think was very useful. And at the time, I was very focused on eventually leaving to start being a full-time investor. And so I was just building up my savings. And when I hit the amount that I was targeting, then I was able to make the jump. And it was sort of a matter of weighing the risks and the reward, I guess, of making that jump. So I think a lot of people wonder, well, what level of security do you have to have in order to make a bet on yourself that you can earn returns in the stock market to support yourself? And it's a very different calculation when, I mean, at the time I was 26, 27 years old when I was leaving, and I have no family, I have no kids. So I don't have to worry about the downside of not being able to support that infrastructure. So for me, the downside was that if it didn't work out and I had to go back to finding a source of income, I could do it. And I wasn't really too concerned about that. So it was a successful bet, I'd say, at this point, because I've had about 3.5, almost 4 years now of full-time investing experience, and the returns have been very good. So ex post, it was a good decision. I'd say it was still, it was a good decision in the moment, and it played out.
Very cool. All right. So then also briefly, what would you say then are now some of your criteria when you're looking for potential microcap investment?
I'm one of the guys, maybe sort of a dying group, who's very, very focused on profitability, which is almost sort of silly because it seems so simple, right? Of course, you'd want to invest in profitable companies. But if you look at typical microcap portfolios, just because there are so few profitable microcaps, it's hard to fill a portfolio with profitable microcaps. I think so I actually have historically invested in a mix of profitable companies and companies that are either near profitability or growing very quickly, so they could reach profitability in a time frame of a couple of years. But I actually did this a little bit of a back test, or I should say not a back test, but I went and reviewed all of my past investment decisions. I did this exercise after a string of losing money in a couple of unprofitable companies a few years ago. And I realized after going back through all my historical investment decisions and the results of them that I was just not doing very well investing in companies that were not yet profitable. And I don't know if it's just this overall statistics that unprofitable companies, I would make an educated guess that it's true that unprofitable companies typically are not as good investments, but or it could have just been my own temperament, is that I was not able to select the right unprofitable businesses that had the growth trajectory to be successful investments. So in the last few years, I have increasingly basically limited myself to profitable businesses. And I'm not saying that I'll never make an investment in a company that's not profitable, but it's, in my opinion, the surest way to reduce the risk of an investment is to invest in a company that has a proven business model, which is shown by its historical profitability.
So what was it about some of the unprofitable companies that, you feel that you made the wrong bet on them? I mean, was it something having to do with those companies in particular, or were you just like, my approach to looking at them is wrong? What was it?
Well, the most obvious thing is that I lost money on the stocks.
Well, fair enough.
When it comes to the companies themselves, I would say that I'm probably not at a significant advantage relative to other investors when it comes to projecting growth rates for high growth companies or companies that expect to be high growth. I do think that over the years, I've become a little bit better at understanding business models and competitive positions, but it's still hard to do. And when you have companies that are pretty early in the growth trajectory, and so much of the expectation is that they'll sustain some growth rate or accelerate some growth rate into 3, 5+ years out. I just haven't historically managed to make smart bets doing that. And it's probably a lot of it is just me. I'm sure there are a lot of venture capitalists, especially, who are really great at doing that, or at least they do it enough and they can have a good enough hit rate that it works out. And I haven't made it work. I haven't been able to make it work.
No worries. Well, listen, you figured out where you do make it work, right? So at the end of the day, like, you don't. If there's one thing I've learned from doing this podcast, from everybody on here has been successful to one degree or another, and it's because they figured out what they're good at, right? So
yeah, and to be honest, I hadn't lost money on all the unprofitable investments, but as a group taken together, they had underperformed the investments that I made in profitable companies. So if I know that my batting average and my long-term investment returns have been much better in this easy to define group relative to this other group that's outside of the first one, why would I ever go back to that group again? So right. It's just simple calculation.
Absolutely. All right. So, look, we've run across each other. We never actually met in person at any of these events that happen all the time. But like, when did you start going to some of these MicroCap events and realize that you needed to go meet management, see the presentations, and realize that was available to you out there?
Yeah, I think it's actually a little tricky. I think I didn't go to any conferences until after college. So when I was working at BlackRock, which was my first year out of college, I believe at that point I began to go to a couple of the MicroCap conferences that were held in New York City, because that's where I was working. And I would have to request vacation time to do that because it wasn't actually for my job. So, and you'll really know who's committed to investing when they take a vacation to go research investments. But I did some of those, and I did also some more of that when I was working at the hedge fund, because I would also take vacation time to research some MicroCap investments, but I didn't do much of it because I wasn't able to invest my own portfolio much when I was at the hedge fund. But I also did it to just keep in touch with other people I liked, other MicroCap investors. And when I first started, it was definitely intimidating, because when you're 20 or 21 years old and you truly don't know what you're doing, and you don't know what you're doing, and you suspect that everyone else knows that as well, you're just trying not to make a fool of yourself, and also hopefully learn as much as possible. So I think I would say that I was very happy to have started going to investment conferences at that time. Mind you, I also ended up going to a lot of investment conferences professionally through my job at the hedge fund, but that wasn't for microcaps. So eventually you go to enough of them, and by the time you're at your 20th or 30th investment conference, you sort of, you don't bring the suit jacket anymore. You don't always have the same level of respect to all the executives that you might have shown when you were 20 or 21 years old.
I was just going to ask you, like, at what number conference did you realize, like, after hearing all the pitches, we're like, wow, that's amazing. Like, I can't believe, like, they're going to do all this. And so at what point, at what number event were you finally like, okay, like, for sure, dude?
I think it happened pretty early, because I had a sense that a lot of these companies were really, really fly-by-night operations, and you couldn't really trust what people were saying. But it took a while to be able to express that openly to other people. I mean, I still wouldn't just say to an executive to their face, I think this is nonsense. I think your business model is just made up and a piece of shit. But I will be much more critical. And if an executive says that they expect to hit some target, and I think that target makes no sense, I will actually push on it much harder now in person than I would have when I first started. I probably would have just gone back home and thought to myself, that made no sense. And at this point, it doesn't bother me so much to bring it up, and really, if they want to argue it, then I'll let them argue it with me and just see what they think.
Awesome. All right. So I got to ask I'm sure you got some great anecdotes. I mean, we all have some crazy anecdotes on some of these presentations and things that you've seen or heard. And this is story time. I mean, what are some of the craziest stuff that you heard and saw? Because I know you've done a ton of these, not just one-on-ones, but you've seen these presentations, some of the things that are said.
Man, it's hard to say individual names, not because I have a problem bringing up individual names.
Oh, no. We don't even have to name the individual name, but like,
I can't even remember some of these companies, because I think the ones that really get to me are where the CEO is a visionary and they're just out of their mind. They just don't have a firm grasp in reality. And a lot of these people are very convincing because they're true believers in what they're saying. And when you talk to them, some investors get swept up in some of what these guys would say. I mean, anyone who would say we're going to change the world, I would just kind of run in the opposite direction. Not because there aren't any, there are going to be people who will change the world, but I suspect that a lot of them are going to be people who don't make that claim, right? If you just grind it out as a successful business and you keep growing and growing and growing, eventually you might change the world. If you've got some new technology that, I don't know, it's going to revolutionize water, or it's going to extend everyone's life, or something that's really, really a huge goal. Those are the ones where I just want to walk out. I've met with CEOs who have been convicted for fraud before. I haven't always known that at the time when I was sitting down to meet with them. And I will always, when I've met with those guys, I've always gotten such a weird vibe that I'll immediately know that something's wrong. And then I'll go back to my computer and I'll Google it, and I'll realize that that person had previously been convicted for fraud, or at least heavily suspected of fraud. Those are always really weird. It's also really weird when you know a person is lying to you in general, and you're sitting with them in a professional context, and you're both wearing business attire, and they're just lying to you. And it feels strange, because it feels like when you put on a suit, it's sort of saying to people that you're a serious person who should be taken seriously. And I maybe that's why I don't feel like I should wear suits around all these people anymore.
Super. And look, to be fair, the reason I wanted to go down this road and talk to you about this is because when we're talking about microcaps, it's so crucial, and it's also part of the inefficiency and part of your advantage in a microcap investor is talking with management and being able to have access to them. And as someone who's been in the trenches, seeing that, I mean, it's important to get all of this out there, because there's folks that are listening to this that don't, they can easily get sold.
I can give you a couple of good stories though. So, I actually have had some very positive experiences with management teams in the past, and some of that has just been from primary research, not at conferences. So one of the investments that I made when I was first starting out, this was 2012, 2013, and at the time it was my biggest investment, was in this little company called Coda Octopus, which now is ticker symbol CODA. I believe at the time it was CDOC. And at the time, it was a 10 or so million market cap company. I really, really liked the valuation, because it was at something like 10 million market cap, and it was doing 5 or so million of profitability. It makes specialty underwater radar sonar sensors. And there was really not research on the company. So what I did in that case was I saw that they were going to be hosting a demonstration day at their offices outside of Tampa for their customers and prospective customers. And I took a vacation to go down to Tampa to attend that demonstration day in 2013. And that gave me more confidence to increasingly scale up my position, which was already quite large. But it was so cool when I think I was 22, and I was down there at this event, and it was maybe 10 middle-aged white guys and me. And on one side was like a Halliburton guy. On the other side was, I don't know, I think an Oceaneering guy. It's a robotics company. And they're all customers or prospective customers or distributors. And they looked at me and they were like, who are you? What are you doing here? Because I had asked the company in advance, obviously, that I could come down and attend, and they said it was fine. But I was the only investor in attendance. And when I told them that I was an investor, they thought I must be a private equity investor because none of them knew that the company was publicly traded. And we went out on a boat that day on the harbor, and they demonstrated the performance of the sonar underwater. It's very cool, actually. If you ever are interested, you can go check it out. It basically gives you a real-time 3D underwater picture. It's very, very interesting, kind of unique. But the funny thing was that after that demonstration day, I think the next month and a half, the stock must have at least doubled. And I wonder if it was because a couple of those guys I talked to down in Tampa had gone back to their brokerage accounts and immediately tried to buy as many shares as they could. But I still, to this day, don't. And I don't know. And also at the time, there were a couple other guys who I knew, one of whom was Connor Haley, who was actually looking at the stock at the time when we talked about it, who might have also been responsible for getting some more traction to the name. So that was an interesting story. And just generally, when you go to annual meetings of companies that are off the beaten path, you can experience some interesting on the ground research. And when you see a company's offices, I mean, I don't know if I can keep going here, but I went to Winnipeg when I was researching the investment I made in FP Newspapers, which is a Canadian company. It's basically the Winnipeg main newspaper called the Winnipeg Free Press. So I went to their annual meeting a couple of years ago, and I think I was the only person in attendance from outside of Winnipeg, let alone the States. I think I was the only one who actually came out of town. I did wear a suit, and I think I was the only one in the attendance wearing a suit, but there were a lot of locals there. And it was another situation where everyone was kind of speculating that I was some big shot banker, because why else was there some New Yorker in a suit who came to this meeting? And there were locals there who were asking, some of them honestly were just not, most of them were not sophisticated investors at all, but some of the questions, I mean, one guy, he was peppering management with questions like, why is the logo on the coffee mugs that you guys use for promotional material, why is the logo so small? And he would just ask and there were other people asking questions that were of similar ilk. And I just couldn't, it was just painful being there as an investor and feeling like these poor guys, the CEO, CFO, have to be answering these questions. It's only one day a year, I suppose. But then you go and you tour the facility, and it's very cool. And you can see this is, in fact, a real thing that I've invested in. It's not just a 10-cent stock on a screen that may or may not really exist in real life.
No, 100%. But real quick, are you still a shareholder in either FP or Coda?
Apologies. So no, I'm no longer a shareholder in Coda Octopus, and I am a shareholder in FP Newspapers. Thank you.
Very cool. Yeah, no worries. I mean, one cool thing is talking about differential insights, right? I had Paul Lunsis on the show, a while back, and we really got into it. And if there's one space where you can really get that, it is in micro and nano caps. Management teams want investors to come up and see the offices, see the operations. And sometimes it's the ones that don't. They're like, okay, there we go. That's an indicator right there. In many ways. Do you have any other both positive or negative stuff? This is great. I love this stuff.
I love looking for differentiated data sets. I just love it. It's like my favorite thing is when you can find a truly differentiated data set about a company. The first time that happened to me was when I was a summer intern in 2010 at this equity research firm. I was trading my own account at the time outside of work. And at the time, I got really fascinated by the company Sotheby's, which runs the art auctions. I can't exactly explain why, I ended up actually being interested in the art market, and I did my senior thesis in college on the art market. But at the time, I didn't really have a good reason, I think, for being interested in it, besides the fact that it was beaten down in the financial crisis. And this was 2010, so it was starting to come back as the art market was coming back.
Did you predict NFTs during that thesis at the time as well? Or
oh my God, so I don't think I can even predict. I couldn't have predicted that a year ago. No,
yeah,
so
right.
what
a week
did,
ago, I mean, geez.
a week ago, what I did, which was I think so great and so much fun, was I realized that Sotheby's, and I don't know if this is true anymore, and they're not even public anymore. They were taken private many years later, but they posted all of their auction results on their website after an auction was complete. So you could actually go and see this painting sold for this much money, this vase sold for this much money, yada, yada, yada. And they only hosted a few auctions every quarter, and they would be big events that would sell many, many, many millions of dollars worth of art per auction. And Sotheby's has a pretty simple business model. Most of their revenue just comes from commissions on auction sales. So it'll take 18% or 20% commission on everything that gets sold. And there's a sliding scale based on how expensive something is. But what I figured out you could do is just go to their website, download all of the actual auction results, and then just figure out how much commission they made on every single thing they sold. And if you added it up, you would actually get pretty much their whole revenue for the quarter, which was weird because from what I could tell, no sell-side analysts were doing that. And I basically just figured out that they were going to shoot the lights out. And I figured out that their quarter, I don't know if it was the Q2 2010 quarter, it probably was either Q2 or Q3 2010, was going to be a blowout quarter. And I knew what the sell-side expectations were. And it was. And the stock was rocketing up that whole time as people kind of figured it out. And it was so weird because I thought this was way too easy, right? This didn't make sense. It was so simple. And I realized that there are just lots of situations like that. And Sotheby's is not a tiny company. It must have had at least $1 billion market cap at this time. My favorite one in the last few years with differentiated insights, which is also, I think, one of my more painful stories over the last few years, was Collector's Universe. And I'm sure you've heard and followed that saga. Yeah. So I got interested in Collector's Universe early 2020, like January. And I had followed the company kind of on and off, looking at it for a while. I mean, this was it was a profitable company. It paid huge dividends for a long time, but it really didn't have the growth. And I saw that in late 2019, especially late 2019, but already coming into 2019, even 2018, the card division, and this is a company that does authentication and grading services for collectible cards and coins. The card division, which had always been much smaller than the coin division, was really ramping up. And almost no one seemed to be talking about it or noticing it. They had no sell-side coverage. And on Seeking Alpha, almost no one seemed to be realizing this was happening either. In fact, the narrative there was that people were concerned that there was a card grading scandal where some unscrupulous people had been trimming the sides off of trading cards to make them look like they were in better condition. Anyway, people didn't realize what was going on. And when you did a little bit of research, you could actually figure out that the card market had been coming back into the public consciousness or what have you. I mean, it was actually becoming popular again. And it was so weird to me that this was being so underappreciated. So I bought some of the stock and I was doing research, and I realized that you could basically figure out how many cards the company was grading, because they had a website that listed in aggregated form also, to make it easier, every single card that they had graded historically. You could see, for example, a Michael Jordan card from this set in this condition. There had been X many of these cards graded by this company. So they didn't give you the day-to-day, and they also didn't provide that information to investors in a public setting most of the time. But you could figure out by getting that data from their website every day, you could see how many cards they graded every single day. And it just required a little bit of elbow grease. And I'm pretty sure if I was better at computers, I could have done it with a macro, but I'm not. So I ended up getting this data set. And while people were trying to figure out what was happening at the company, I knew how many cards they graded every single day. And at the time, I ended up pinging my buddy Connor. I ended up talking to one or two other people about it as well. And I told Connor, this is up your alley. You got to look at this thing. So I didn't really know what he was going to do with it at the time, but he basically fell in love with this idea and really ran with it. And a few months later, I was looking at filings from Connor saying that he wanted to, like replace the board. And unfortunately, that was a situation where, because so few people had the same differentiated information that I had, they didn't realize what was happening as it accelerated. And I think one lesson that I learned from that, so what happened in the situation was that the company was acquired, and there were some, I'd say, less than above board tactics used by the acquirers in that process. And I'm sure Connor can rant about that if you ask him about it as well. But a lot of that came down to the fact that the people who were really bullish on the name had better data and they understood what was happening. And the people who didn't have that data were likely to underappreciate the growth prospect and the acceleration of it and sell out at a lower price. So by keeping that information kind of close to the chest, which I did because I thought of it as a competitive advantage that I had that data, I shared it with a few people, but not the public. I think that was sort of at ex post, I was doing a disservice to myself and to all other investors in the company. And maybe if I had shared that information earlier, it could have gotten more people more excited about this, about what was actually happening at the company. And maybe that could have prevented the takeover at what we consider to be an unfair price. And if you look at what the company's disclosed publicly since then, they've doubled all of the pricing for card grading. I think they've taken the rate of card grading up 2 or 3x in the last 9 months, which was already apparent and from some of the data before they actually closed the deal. And I'm sure they're making out like bandits on it right now. So a little bit of a harsh lesson, but it was still at the time, I think, really fun.
Let me ask you this. I mean, using that example, I mean, what was some of your reasonings to not share that? Were you still building position? Were you kind of nervous, like you're going to run it up, and you still didn't build out the full position? Like, what was some of your reasons?
Yeah.
Most would say it's a team sport, but there's reasons why you might not make something like that public.
To be honest, what I was thinking was that if something changed in the data, I wanted to be able to react to it. If it accelerated, I wanted to be able to increase my position first. If it decelerated, I wanted to be able to reduce the position size first. I did share it with some people because I have friends who are in the stock who I know well, and we share information, and they were appreciative of it. And I'm happy to share with my friends. But it's tough sometimes when you feel like you have a competitive edge. You don't necessarily want to give that away for free because that's your edge, right? But at the same time, you have some weird situations like this, and I didn't really expect it to play out like that, in which case giving away the edge would have actually been a better outcome for yourself and for everyone else. So
for the next potential idea that comes through where you were able to find this differential insight based on public information.
Oh, yeah.
I want that to be clear as well. Yeah. Like, this is all public information. You were just able to discern from that a competitive edge, so just want to make sure that's clear, but like for the next time that does happen, what do you feel like you would want to do? Do you feel like you'd want to make that more public, or do you feel or is it just a case-by-case basis?
It's so hard to say. I think at this point, I'd say it would still have to be a case-by-case basis. And certainly if I'm accumulating a position still, I'm not going to be interested in doing that. If I've established a full position, and at that point, I think other people should understand what's going on, then sure, as part of making that pitch, it might make sense to explain everything that you're using as part of your data set.
So, this is also a great learning lesson for those that, are, because we were just at the MicroCap Club summit, the virtual one yesterday, and during the virtual happy hour, it was interesting to hear how Well, firstly, there's so many new folks that are into microcaps, which is awesome. Some of them probably are listening right now that said they listen to the show. So, for those, thank you. But, maybe we can go a little deeper into finding some of these differentiated insights and where you go to actually look for that, and what maybe some of the clues that you see when you're doing your deep dive due diligence, like, oh, that I want to look into that a little bit deeper because I think that might help me with my edge.
Sure. I think the simplest thing that anyone can and should do is figure out how much you can get publicly, even if it costs you a little bit of money, and even if it costs you a little bit of your time and effort. So when I say that, I mean, if it's the simple version of this is something like, if you invest in Google, you should have used their search engine and understand their product. Same thing if you invest in Apple or Amazon, and those are probably very understandable for people. But if you invest in a company that, let's say if you invest in a newspaper like the Winnipeg Free Press, the FP newspaper's investment, it would probably help you at some point in your investment process if you subscribe to that newspaper, because that will give you a sense of what their product actually is. And who knows, there might be interesting insights you can glean, whether it's announcements in the newspaper about changes to their operations, which happen on occasion, or viewing what their advertisement base looks like. So that sort of thing is possible sometimes. It's not possible if you invest in a heavy industrial company. Most likely you're not going to go and use some giant, steel stamp press at some factory to figure out if they actually manufacture good stamp presses. But to the extent that you can, I think it makes sense to do it. That also applies to things like industry trade magazines. I've definitely learned things from looking at trade publications, and some of those just cost a couple $100s for a subscription, which you can cancel at any time you'd like. Going to industry conferences can help. If you're located in New York City, which I was for many years, it's actually shockingly convenient to go to attend some of these things. And it's very cool when you get to see a company at their booth at a trade fair, as opposed to at the table at an investment conference. And you'll also most likely run into some of their customers, some of their competitors. You'll see a lot. So those can just be very interesting. And I mean, I don't know, a couple of years ago, I went to a security industry trade fair in New York City. It was at the Javits Center. And I must have visited with at least 5 or 6 different publicly traded companies at their booths. That included everything from, I think NAPCO, and I don't own any of these stocks, but NAPCO, which makes fire alarm related technologies, George Risk, which is an interesting little tiny microcap, nanocap family controlled business, which makes pool alarms. There were some bigger companies there. There was a company that manufactures surveillance systems that I was interested in at the time. So it was just interesting being there, and it wasn't so expensive. I think I probably spent $50 maybe, and it just took a day or a morning. And I love doing that stuff. If I could do that every day to the extent that my schedule allows it, I would do it.
How has that process changed now, in COVID time? I mean, things are starting to open up a little bit, but I mean, the last 18 months, like what, you weren't just sitting on your hands, not looking at potential new ideas or checking in on other ones, right? So like, how were you able to adjust some of what your normal process is?
Yeah. So it's actually gotten, it's very different. In some ways it's easier because a lot of companies have made the effort to put things online so everyone can do the same conference online instead of having to be there in person. But yeah, not being able to go to conferences for industry conferences, that's a little different. Just if you're wary of traveling, then going to an annual meeting that's being held in person, obviously that's going to be a challenge. It just makes you change a little bit. I mean, look, when I was investing in Collector's Universe, I was actually not even in the United States for almost that entire time. Long story, but I happened to be trying out a remote working group trip. And I started that trip just before COVID hit, beginning of 2020. I was in Vietnam for almost all of last year. And I couldn't really experience, I mean, I would have liked to have sent away some cards to be graded by Collector's Universe. I was very wary of sending them from Saigon and getting them back. But you just adapt. You change your operating processes. And to be honest, a lot of being a good investor is the ability to be flexible and to change. And if you have a cookie cutter process, then you're not going to be able to change. And when there is a differentiated insight, you might not find it, because most companies have their own little idiosyncrasies. And there are some companies that will lend themselves to some kind of analysis, and there are other companies that will lend themselves to a completely different analysis, or some companies that really won't make it easy to do any analysis at all. So you have to be willing to flow and find where the cracks are, I'd say.
Very good. All right. So I wanted to, obviously the main way that most folks interact with you is via Twitter. I mean, I know you're on a 2-week break right now. We're recording this on September 24th. So
yes.
I know you're on a little break right now.
I was too addicted to Twitter.
Dude, I was literally talking to my wife about it last night, where I was like, I feel like my mind was a little sharper, maybe like a week, like a couple months ago, but then I got back on, I was more active than I usually am on social media. So like, I totally relate to exactly what I should probably take a little break. Well, I can only really do the weekends. I'm in media, so it's not like I can, but like, anyways, long story short, you talk about a few of your names on there. Actually, I'm not sure if you're a shareholder of a few of those names, but you talk about a few of those names on there. First question is, what drives you to want to then talk about some of the names that you're interested in on your Twitter account a little bit? And then also, I mean, you talked about some cult names that we've known for years, of late, very recently, from Galaxy Gaming to Fit Life, so, love to hear some of your thought process around wanting to engage in the conversation on some of these ideas. And then in particular, some of those cult names. Full disclosure, not a shareholder of either of those.
Yeah. Okay. So the most obvious reason for talking about an individual stock that you own is to find other people to invest in it and hopefully get the stock to re-rate to a fair price, which would accelerate the process of making money on it. So I am unashamedly interested in doing that. I think there's a way to do that that's not unethical, or what people call as pumping a stock. But if almost no one's ever heard of a company before, then to explain the value proposition and why it's an interesting investment, I think that makes a lot of sense. And I think the other reason, which might actually end up being more important in the long run, is you meet people. And I can't tell you how many of my current investment friends, investment relationships that I've had, I would have had without being public in some way or another, whether it was on MicroCap Club or on Twitter. And just having that network is so valuable. When it comes to those names, I mean, so I'm a shareholder of Galaxy Gaming. I'm also a shareholder of Fit Life. And when I only found these names and many other names that I've invested in through other investors who I've been close with over the years. I've mentioned in the past, Jason Hirschman is one of my favorite investment friends and one of the smartest, most successful guys out there.
We love Jason.
We love you, Jason. And he's been very public about Galaxy for a long time. And sure, I had been aware of the company going back many years prior to that as well, but I didn't really understand the company's product offering. And when someone can lay it out for you, it makes it so much more possible to get the conviction to own it. So I'd say I'm very happy to be public about a lot of what I do. There are times when I will not talk about something publicly when I'm trying to buy a stock and it's really illiquid. It just doesn't help. to point your finger at it as soon as you first find it. And I understand it's not the way to get everyone else into it at the best price, but at the end of the day, you're trying to make good investments. And I've had companies where a stock might only trade once a week or less than once a week, and it could take a long time to build up a position. So there are always going to be some situations like that, but the vast majority of my holdings I have been public on Twitter. So I don't want to give the wrong impression that I'm mostly secret about stuff. The norm is that I'm public about what I own.
And you know what? And I think it goes back to the age-old lesson of just like, especially in the investment community, you know, and some of these investment groups, you know, like MicroCap Club and others, is that, you know, if you give a little, you're going to get a lot in return. Right? You know, you give a little bit of insight onto what you're looking at and why you think it's interesting, whether you're right or wrong, it doesn't matter. It's the fact that you're willing to give a little bit, and who knows, you never know what can come out of that. You know, you might find others that agree with you, you find others that disagree, and both of that can be extremely helpful. And this is mostly a message to new microcap investors, right? That might not maybe be active on FinTwit or any of these other platforms, that, like, you know, it can be a really beneficial thing for you to grow as an investor, is getting, you know, not just staying in your own bubble and staying in your own cocoon to say, you know, pat yourself on the back, like, you know, I think I'm right. And then, you know, you never know, you might be extremely wrong.
Yeah, I will say I have received since I've been on Twitter and since I've gotten some more of a following on Twitter, I've had many people reach out to me, messaging me with investment ideas. And most of those people are relatively inexperienced, although there are some who are pretty experienced investors. And a lot of them just want to get feedback. And for the most part, I'm very happy to do that. Some of it's self-serving, because if they have a great idea, I'm thrilled that they're pitching it to me early. But I'm happy to give feedback. And look, a lot of it is pretty straightforward stuff. I mean, a lot of the companies that people pitch to me, I've actually researched them before. So I can usually give, I mean, maybe not usually, but very often I can give people a pretty good piece of feedback about, you know, why I don't own that company, why I don't own that stock. But I love to learn. And there are always situations that, there are often situations where people will pitch it to me. And even if I still don't really like it as an investment, I still learn something. And it's great to learn something new.
Absolutely. So, and by the way, people aren't just in you to be on podcast, you know, they're also in you have to be on podcasts too, right? I mean, the case in point right here. Gotta love that.
Yeah.
So actually going back down another rabbit hole that I want to, you know, speaking of Collectors Universe and activist campaign on that one, you know, but using that kind of as a framework, you know, we both started to see that it feels like there's this kind of new age of activism. Maybe it might not be new age, and maybe just by new age, I mean, you know, we're just seeing younger folks now doing more activist campaigns and microcaps. But, you know, what have you observed? What have you seen? I mean, it's clearly gotten easier for, you know, the retail investor to start, you know, wanting to see more change in the companies, especially in microcaps that they're invested in.
Yeah, I would say that it seems to be going hand in hand with the overall abandonment by institutions of the microcap space. I mean, you've seen what's been happening with the OTC markets over the last year or two, and there's this shift increasingly that regulators have taken to basically protect investors from themselves by placing more and more small microcap stocks off limits if they don't meet disclosure requirements, for example. But for a very long time, these companies have not really fit in any meaningful way into the institutional framework. It's not profitable for a bank to establish coverage on a company that does not need to raise a lot of equity because it's profitable and does not have a lot of trading volume or liquidity. There's just no business model there for institutions, specifically the sell side, and to a lesser extent, the buy side, to do anything with it. And I've experienced this firsthand when I first started learning about microcap investing. When I would talk to some sell side guys I would meet at conferences, I would always be interested in whether they would look at a company for the sake of eventually picking up coverage of an under-followed name. But the fact is they just don't do it. It doesn't make sense for them as a business model. So when you have that structure, the only companies that do eventually get coverage in this space are the ones that need to raise a lot of equity or other financing, which typically means that it's the lower quality businesses that end up having some following institutionally. And the higher quality businesses have just fallen through this crack. And a lot of people know that this exists, that this blank space in the market exists for tiny, high quality businesses that don't need to raise capital. But most people also don't have any interest in it because it's not a place where buy-side firms can invest a lot of money. So it's really just filtered down to people like you and me who have to run with this and carry the torch for it and be digging through the weeds or the garbage heap, whatever we want to call it. And some of those people have enough capital and they've built up enough of a reputation that they've now been able to seriously consider making some changes at a company that isn't performing the way they think it could perform and that it should perform. So it's this weird environment where the only reason that it exists in the form that there's now some activist investors in the nanocap space is because no one else is there. So they've just come in because there's this void. And I think it's interesting if that's going to progress to these same people working on larger activist campaigns, or if there's going to be more people who come in to do the same kind of work in this space. To be honest, it's not a very big space. There's not that much money right now to be made in it. It's just there aren't that many people going after it, and we'll see how the next few years play out. So I think it's interesting. I wouldn't say it's part of some huge trend, but I think there's some money to be made. Yeah.
100%. And also you got to look at the incentives, right? You know, if you're talking about some of these institutions that manage, you know, they have a solid amount of AUM, they're thinking to themselves, man, activist campaigns, like that's a lot of friggin' work. Like, you know, what is my eventual payout if we really are going to put in the time, effort, and resources to do that? Whereas for, you know, a lot of retail investors that I've spoken to in the last year or so that have been wanting to be more active, you can see that there is a lot more incentive for them because that might be their largest holding.
Yep.
You know,
yep.
And it just makes more sense where, you know, their expenditure on differential insights is because they've already seen what the value gap is and why this thing should be worth more, and they're willing to put that money to work to invest to make sure that it gets there. And this is the way that they can do it.
Yeah, I'd agree with most of that. I would add one additional thing, which is that I think it would be interesting to see how this plays out domestically versus internationally, because as a lot of people know, the United States has not been a very good environment for activism, and specifically when it comes to you know, hostile takeovers and that sort of thing. Since the rules of the game basically changed back in like the 80s with the poison pill. But there are a lot of other markets now that a lot of small microcap investors look at. And I think many of those markets are more hospitable. The frameworks in those markets might make more sense for activist campaigns. So I would be interested in seeing how many microcap investors end up going down that route. And you've seen it. I mean, so I think you've seen it. And I don't own any of the names I'm about to mention if I mention any, but so like Jeremy Raper has gone after a couple of situations now in Europe. Not all of those were successful, but you know, there are some interesting situations he worked on with Hunter Douglas, and there was a Cambia automotive retailer, car dealer, and Connor Haley went after N Labs, which is a Swedish company. And these are interesting situations. I wouldn't say that they were necessarily, some of those could have been done in similar ways in the US because these were related to takeovers. But I think you're seeing these American investors look internationally, and that's interesting.
Very good. All right, I want to segue to going back to Twitter real quick. Unbeknownst to you, because you're not active on Twitter right now, I put out
What's
a tweet.
going on?
No. I'm sorry. I don't mean to scare you. No. Mid interview, I put out a quick tweet saying I'm recording an interview with you right now. You got any questions? And we got a question in. So don't worry. You be prepared. This one you're gonna
Okay.
you might have to send it to your compliance officer right after. But the question is from at Adu Subramanian. I apologize if I butchered your name. I'll do better next time. He asked the question: how do you filter what you consume from research about stocks to daily news? And part two is the best way to get in touch with management when researching companies, and when do you reach out to IR management in the research process, in your opinion? Some good ones in it.
Yeah.
You won't have to.
Yeah. So I would say. So what was the first part about? That was about the
filtering.
Filtering the news, right?
Yeah.
One way I'm doing it is by taking a 2-week break from Twitter. Look, you have to just work in whatever way works for you. I know it's not really helpful to say that, but I guess for me, I don't watch television. I don't own a TV, and I don't really watch TV much on my computer. I certainly don't watch the financial news. So that's one way to reduce a little bit of the distraction. Some of my data sources that I've used and liked to use historically is I really love blogs, right? So historically, I've loved to read microcap blogs, and it's really fun if you can put all of that together. So what I did was I just got one of these free RSS feed aggregators. I use Feedly. No, I'm not being compensated for mentioning Feedly. I'm sure there are others out there. And I just get it's not quite a scheduled thing. It's not like a daily digest, but it ends up being something like a daily digest of blog posts. And so every time there's a blog post, and I probably have, 100 blogs that are all being fed into this aggregator. So I can just get my news on the best new stock pitches like that. I do read forums like MicroCap Club, and I'm a member of MicroCap Club. And I love to read filings. I love to read financial reports. So I will go through lists of recent daily financial reports when I have time, and I will just look at them. Like if it's a real company and I've heard of it before, I will pull up its recent quarterly or annual filing, and I'll just see what's going on. And most of the time, that doesn't mean anything. It doesn't result in any actionable thing, but you never know what you could learn. Sometimes you find a great idea. Sometimes you learn something that's tangential to something else. Sometimes you find out something that's happening in an industry that you didn't really pick up before. And then you have to go back and think about something else, that some other company that you've looked at before, and how that business might be changing. So that would be about the data. And the other question about contacting management and IR, it depends, because I have sometimes met a company for the first time at a conference. In that case, you're getting it first before you really do much research. But I don't think you should wait forever to contact management. There are some people who say you should really have everything done, pencils down, you've modeled everything, you've probably bought at least a starter position, and then you call management. I don't know. I don't necessarily agree with that, but there are times when I never talk to management, because sometimes it's not necessary, right? If you invest in a company that you understand really well, because there's a lot of information out there and you can figure everything out, and you're just comfortable, then sure, at some point maybe you'll call management, but you should always be thinking about why you're doing something, right? So I think one reason why I might be hesitant to talk to management is because I always am concerned about being led in by a good story. So I will say, over time, I think I've gotten better at being a judge of good stories and bad stories, and what to believe. But it's just tough. Sometimes people are really good salesmen, and I have some of these situations with unprofitable investments I've made in unprofitable companies have been because someone was a really good salesman and I'm a bit of a sucker, and I probably should have kept my head into the financial statements a lot more and not listened so much.
It's hard. I got to, I mean, listen, I do, a lot of CEO interviews and do interviews with management that way. So it's not like they're as in depth as, an investor one-on-one when you really dig into the story a little bit. So it's an art. It's really an art to try and figure out like, well, what are some of the questions that I know will get me, kind of the answers that I'm hoping for and looking for. And then also just going in knowing like they're going to do there's not a lot of management teams that'll give you kind of the reality, and also explain to you the downside. There's very, very few. Very few.
I hope you're not hoping to get the bear case from your management talks.
Yeah. Well, and listen, to be fair, like, we've both gone to like MicroCap Leadership Summit, in person in Chicago. And I've sat in on a few of the roundtable sessions where there have been, and it's usually the more quality management teams that'll kind of give it to you straight a little bit more as well. That'll say, look, here's what could go wrong, And like, I don't know, at least for me, like I always appreciate that. Rather than just everyone saying like, all right, here's the full flowery picture, especially ones that get offended when you do say, well, what could go wrong? That definitely, they shouldn't be taking offense to that question. Like they should expect that to be coming,
Yeah.
But anyways, so look, we're around the bend here, and I haven't even asked my favorite question I always ask on here. So, what would you say is an investing experience that really changed your career the most, or changed your thought process as an investor the most?
That's a little tricky. Well, I think I'll go with the easy answer for me, which would be my investment in Expel. So Expel has been, and full disclosure, I am still a shareholder of Expel. Although I am short some covered calls on my position. So, and that's for tax optimization rather than booking taxable gains at the moment. So I invested in Expel 3.5 years ago or so. It was right after the Q1 numbers came out in 2018, which were blowout numbers. And the stock went from $2 to $3 in a day or 2 days. And I didn't own any when it was at 2. And when it went to 3, I bought quite a bit. And that went against almost everything that a new investor thinks they should be doing. You invest in a stock that just went up 50% or more, even though you already knew about the company before and you had looked at it and you hadn't owned it. And I think what I learned, or one of the things I learned from that was, I really shouldn't call it learning because I probably would have said that I already knew this, but you really have to take the historical price and the stock chart out of the picture. You have to look at everything just as it is today. And when I looked at the numbers, I saw, and I'm talking about per share figures now, the stock was at $3.20, and it had just reported a Q1 with 8 cents of after-tax income per share. So you can do simple arithmetic, 8 cents times 4 to annualize it, and Q1's historically a weaker quarter. So 32 cents of income on a $3.20 stock price, that's 10 times earnings. And they just reported a quarter where I think the top line was something like 100% organic growth, maybe a little less than that. Obviously, the bottom line grew much faster than that. Almost never have I ever seen a company that posted a year-over-year growth of 100% organically, top line, profitable at a run rate earnings of roughly 10. And I was willing to buy a stock for at least 50% more than the price it was the previous day or 2 days because the numbers just made perfect sense. And there were some people who were probably very happy to get 50% more than they had the day before in their brokerage account. And those people missed out on one of the greatest home runs in the microcap investment world in the last decade, or I don't know, more than decade. And I've held the majority of my position because the companies continue to execute and the price has always made sense. It's never been that cheap again as 10 times earnings, but the willingness to own a high quality company at a price that makes sense is something that I didn't have 5, 8, 10 years ago. I traded in and out of some really high quality companies before. In the past, I even owned stocks like Google. When I was in college, I think I owned some Google. And at some point I sold it because it was just, it was not crazy cheap. I think it was at something like maybe 12 or 13 times adjusted income or something. And I mean, why should I own that? Is it going to go to 30 times? And so anyway, I think I learned a lot. Some of it was from just having more experience. And I hope that I can just keep getting better, right? I'm definitely making better mistakes now than I was 5, 10 years ago.
Very cool. All right. So to close this out, my last question today, what advice would you have for new microcap investors that might be listening to this right now that, are want to gain that edge? That want to, just be the, really, really get after in microcaps.
Sure. So I will say the hardest thing about being a good investor is that you have to love doing it. And this is probably underappreciated. It's not fair because you're not born with the ability to fall in love with whatever activity you would like to fall in love with. And it's not fair that someone who would really like to be good at something can't necessarily choose to want to do it and to just enjoy doing it. I love games and I'm a bit entrepreneurial. So it was really easy for me to fall in love with investing. I think if you aren't really in love with it, it's not going to be worth your time to beat your head against this and to try to become some genius investor, some incredible investor. I'm not saying that people cannot become better investors or they shouldn't try to become better investors, but people should focus on the things that they really like to do first and foremost. And then if you really love doing it, you almost won't really need to ask the question of what should you be doing because you'll be doing everything. And when you love doing something, you won't need anyone to tell you to go that extra mile. I mean, I went to some of these investment conferences when I was in New York City taking vacation time, not because it was a slog. It was like waking up on your birthday and you get to go to this conference and it's so exciting. And you would have rather been doing that compared to actually going on a vacation that day. And if you feel like that, you will find the stuff to do, I think.
That's a great place to end it and really well said. So Harris, with that, where can people go and follow you on social media when you do eventually come back?
Well, I think I said on Twitter that I'm going to be back at the end of the month. So I will be back at Otter Market on Twitter. And other than that, I post sometimes on MicroCap Club. And if you send me a direct message on Twitter, then maybe I'll give you my email address and we can take it from there.
Very good. Well, Harris, thanks so much for joining me today. This was a lot of fun. Good luck. Stay safe. And I really look forward to our next chat.
All right. Thanks, Bobby. A pleasure.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.